Welcome back. Wrapping up this week's trading action, we can see here the S&P 500 closing prices for the week, for the day, are in yellow. The red line shows us the weekly lows. The blue line shows us the weekly highs. We can see a very small trading range this week, closing right off the low. Now, here we can see a little bit of a better picture. This is only this week's trading activity. So we hit highs around 41.55 and lows around 41.30 for the S&P 500. Again, closing just a hair off the low of the week, which is not really very significant because we have such a short trading range. We can see that as markets tend to develop a trend, the width between the high of the week and the low of the week really does tend to narrow. Now, contrarians out there will say, well, this narrowing of the range does eventually lead to breakouts, and they are correct in saying so. But we need a catalyst, we need an acceleration in volatility in order to see that. Here we can see the white histogram bars show us Friday as a percentage of the week, meaning did we close at the high of the week? In that case, the histogram bars would be near the top, or at the low of the week. In this case, the histogram bars would be at the bottom. The red represents the S&P 500, and we can see we can close right off the low. The reason why it's important is because notice during the uptrend, we tend to see several weeks, several high histogram bars, especially going back to December and January. We saw a nice, healthy uptrend. Really does not look like a very healthy uptrend. Otherwise, we would see these white histogram bars occur more frequently like we saw, again, late December, January. So I think that stocks are going up. It's a little bit deceiving because they are going up slowly. Selected issues are going up, but it is not by far a broad-based rally. Every yellow dot here represents one stock in the S&P 500 on the RSI Relative Strength Index scale. Readings above 7, you're considered overbought. Below 30 are oversold. We can see the vast majority of the stocks are between 30 and 70. The dotted line in the middle is a 50, neutral level, so to speak. It's a very mixed market. I don't see that there's any clear trend, so to speak, at least on the overall broad-based market. We can see here the yellow histogram bar show us the number of stocks at each respective RSI bracket, so to speak. The highest bar here shows us there are around 88 stocks in the S&P 500 with an RSI, a relative strength index between 50 and 55, a nearly equal amount between 45 and 50 and 55 and 60. It's a pretty evenly dispersed market. But we would like to see in a trending market, we'd like to see more stocks above 50. It really is a very neutral stance. Every dot here represents one stock, again, in the S&P 500. In this case, we're looking at each stock in respect to its own respective 52-week or one-year range. Now, if we were in a very strong uptrend, we'd see most of the red dots, most of the stocks near the upper end. 100% means that the stock is at its new 52-week high. 0 indicates new 52-week low. Again, it's spread out very, very evenly. No real direct correlation here at all, or any direct trend that we can detect. Here we see the count of the stocks at their respective 52-week range brackets. We see probably just as many stocks near the 52-week highs as we do near the 52-week lows. These are the top 10 industries that are found within the stocks in the S&P 500. Number 1, service, amusement, recreation, life insurance, mining, pharmaceuticals, telecommunications. These are the bottom 10 industries. Specialty chemicals, oil field services, biotechnology, apparel. Point being is that there is not, again, a clear trend, I think, in terms of sectors either. When oil is hitting new multi-year highs, we would see the top 10 industries dominated by oil drilling, oil services, etc. Or we would see, a lot of them gold mining stocks near the 52-week lows. This is not the case here. It's really spread out very evenly across the board, which, on one side, you could argue, well, that's a healthy market, but on the other, there's not really a clear trend, and I think that there's a lot more going on than what we find here. Overall, we see the sector RSI. This is the change, the percentage change in the not the percentage, but the RSI, the number count change within a relative strength. So we see the greatest expansion we should see, or the greatest growth lately we've seen: office equipment, supplies, biotechnology, oil and gas, transmission, specialty insurers, food chains. Those sectors that have lost the most in terms of their own respective RSI include the home builder index, paint supplies, saving institutions, medical services. Again, not a clear correlation between the sectors. Now let's get to the bonds, because this is a lot more interesting. We see here at the bottom, the x-axis shows us the different U.S. Treasuries from the 1 month all the way to the 30-year. The 1 month pays at 3.4%. And I think the most significant thing to talk about in this week's wrap-up is the 1 month U.S. Treasury bill. 3.4%. Why? Well, it's 3.4%. The 2 month is at a 5.04. The 3 month is at a 5.12. And the highest yield we see here is at the 5.17. I believe the last time we spoke, the highest yield was on the 6 month. What we're seeing is a continuation. And if you go back to see some of our other earlier broadcasts that specifically talk about the bond markets, which we focus on a lot, we'll see that the highest yield at one point several months ago was on the 1 year. Then it was on the 6 month, now on the 4 month. And we could see this almost looks like an ocean wave that's moving to the left. This is occurring because, in my opinion, because the Federal Reserve were getting closer to the end of the interest rate hiking cycle. And the longer term bonds, like the 10-year, it shows us the likelihood of high interest rates further on down in time. Now, let's say 10 years from now. I don't know if it's, you can say that, okay, well, this means that 10 years from now, we're going to have 3.54% interest rates. But loosely, we can say that the bond market is telling us in the long-term future, we see lower interest rates than at least we see in the near-term future. And the fact that we see the interest rates, the highest bar has moved from 1 year to 6 month and now 4 month. It's telling us that the highest interest rates, the bond market sees it's coming closer and closer. We're coming closer to the end of the highest interest rates. And we don't have to go out very far to see lower rates, only the 1 year, and we see lower rates. Now, this is the 1 month percentage change in yield of the U.S. Treasuries. And this shows us, really a very staggering picture. The 1 month bond, the yield for that 1 month bond, now it is volatile, so you'll see big swings. It's down 21% in the past 1 month. The 2 month is up 13%. The 4 month, remember that's the highest yield we see right now. That's at 8%. More or less the rest of the Treasury market is moving at the same clip, except for the fact that the 1 month yield is really falling apart. We're going to talk about that, what that means, in just a minute. This shows us the this month in bonds. The blue histogram bar shows the S&P 500. Again, if you look just at the stock market, it's a very boring picture. These histogram bars are very close together. It's not going up. It's not going down. Take a look at the black dotted line over here. That's the 1 month U.S. bill. It was at one point at 4.7%. That was early April, just a couple weeks ago. And now we see the U.S. The 1 month bill at 3.4%, a huge drop. It's crossed below virtually every other security we have here. Now, let's go back in time a little bit. This is the 10-year versus the 1 year in the year 2000. The 10-year is a black line, the red line is a 1 year. We had an inverted bond yield curve where the 1 was above the black, above the 10. It crossed back below very quickly. The blue background chart shows us the spread, meaning the spread between the red line and the black line, the 10-year and the 1 year. When we went from an inverted bond market where the blue area chart was, inverse, it was down, that shows us the inverted bond market. Then this shows us a regular bond market. We may say, oh, well, that's good that the spread is now normal. but it depends in which direction the bonds are going. It's not that the black line, the 10-year, went up. It's that the red line went down so much faster. It's the collapse of the short-term yields. This shows us, and this is the same period of time, the year 2000, the red histogram bars and the black histogram bars show us the rate of change, how fast the red crossed down, the 1 year. Take a look at these red histogram bars right here. That shows us the collapse of the 1 year. This is 2007, same chart. Red is 1 year, black is 10 year, and we see the 1 year collapsed, and that showed us an acceleration of the spread. But just because the 10-1 spread was going up, that's not necessarily good news. That doesn't mean that the black line, the 10-year, went up. It means the 1 year, the short term, went down so much faster. This shows us a rate of change. When the one collapsed, look at the red histogram bars here. That shows us how fast it was going down. By the way, this is 2008, and we all know what happens with the stock market at that time. Now, that's the 1 year. So far, the 1 year is not really collapsing like we've seen in the past. This is the 1 year right now, red line. It's still above the 10-year. We still have an inverted bond market, we can see, because the blue area chart is inverse. This is the rate of change. The red line is a 1 year, and we still see positive levels over here. It's not happening yet. Nor, by the way, is it happening on the 10-2-year spread, still inverse. But before the 1 year changes, we expect to see the 1 month change. And here's really the point. Take a look at the gray area chart is the S&P 500. Now, this is 2007, 2008. The 10-year is a purple line. The 1 year is the red line. We had at one point an inverted bond market all the way on the left-hand side where the 1 year was above the purple, the 10-year. The 1 year crossed below the 10-year, and it's a little difficult to see. Just focus on the red line that really went down fast. And that led us to the 2008 stock market crash. But notice what happened before the 1 year bond went down. The black line, the 1 month Treasury. That had a huge move down. The 1 month Treasury was standing at the time at 4.7%. That was August 9th, 2007. Had a huge sell-off August 20th. Just 11 days later, went from 4.7 to 2.47%, about 150 basis points. And notice the black line, the 1 month bond again, led us down as the stock market really started to collapse. Now, the 1 month bond, the red line, did follow, and they both moved away from the purple line, the 10-year, but the first signal was really the 1 month bond. Well, fast forward to present day. The white histogram bars show us the S&P 500. The 1 year is red. The purple line is the 10-year. Still an inverted bond market. The black line is a 1 month. Look at that collapse. Now, it's still early and we don't have a lot of data, so I don't know if it's fair to make this comparison. But going back to 2007, the black line, the 1 month, look at how that had that huge bad month. August of 07, that was really the beginning of everything to come. Kind of looks like what's happening now with the 1 month bond. So we have to look for confirmation. And the good news is that, let's say our premise is correct and that the 1 month is going to go down and then the 1 year, the red line, is going to go down. Well, we have a lot of time because look how long it took in 2007. The 1 month collapsed in August. The stock market was still hanging in there until probably, well, it's safe to say, maybe December. We had about 4 or 5 more months. During that time, the 1 year, the red line really started to collapse, and then the last thing that happened was the stock market collapsed. Well, fast forward to present day, the first maybe possible signal is the 1 month. Maybe that's happening now. The next real source of confirmation will be if the 1 year crosses below the 10-year. The red line crosses below the pink line. Now, we may not look at these charts every single day, but it's very simple. You go on any, Bloomberg.com, the Treasury website, any website that has the current Treasury market prices, and look at the yields, the 1 month, the 1 year, and the 10-year. And we can see, make a note when we see the 1 year cross below the 10. Now, it may not happen. It may not be the case where the 1 year crosses below the 10. Maybe the 10 crosses above the 1. Because remember, the spread's increasing. This is the year 2000 again. The spread increased, but it's not enough to note that the 10 is above the 1. Is a black line going up, or is it a red line going down? Is the 10-year, the long-term Treasury, going up? And if that happens, what does that mean? It means the long-term outlook looks good. It means that the Federal Reserve is more likely in the future to have higher rates. Why? Because stocks look great and the economy is improving. It's not going to happen all at once, but let's say we have good job reports and inflation kind of cools and the GDP numbers look better and construction, all these other things start to look better. We'll start to see long-term interest rates move up. Going back to where are we now? Current U.S. Treasuries. We want to see the 10 years at 354, the 20, the 30 year. We want to see these start to creep up. And we want to see, well, it's not that the short-term rates are going to go down, but we want to see the long-term rates go above them. Maybe a little bit of an equalization. But on the other hand, if we see the 1 month is at a 3.4%, and then we see, this is a 1 month change, we start to see the 2 month, the 3 month, the 1 year start to follow the 1 month down, maybe that could be a sign of something else to come. So we're going to watch these prices very carefully. Meanwhile, the stock market is kind of boring, but the bond market gives us sometimes some insight into these prices. And we're going to continue to watch this very carefully because it certainly is a lot of fun to watch and very, very interesting lately. We hope this has been helpful. We look forward to seeing you back soon.